Avoiding common pitfalls, essential risk management techniques for Forex traders. Hey everyone, and welcome back to the channel. Have you ever placed a trade, feeling super confident, only to watch it turn against you and wipe out a big chunk of your account? It's a painful feeling, and honestly, almost every trader has been there. But what if I told you that the key to long-term success isn't just about picking winning trades? It's about protecting your capital when trades go wrong. Today, we're diving deep into the essential risk management techniques that separate profitable traders from those who burn out. This is the stuff that will keep you in the game, so you definitely want to stick around. First up, let's talk about the golden rule, the 1% rule. It's simple but incredibly powerful. Never risk more than 1% of your trading account on a single trade. If you have a $10,000 account, your maximum risk per trade should be $100. Why is this so important? Because it makes you psychologically bulletproof. Even if you hit a losing streak of 5, 6, or even 10 trades in a row, which happens, by the way, you'll still have most of your capital intact. This rule prevents one bad decision or one unlucky market move from blowing up your entire account. It's your financial seatbelt. Always wear it. Next, let's discuss the magic of stop-loss orders. A stop-loss is a preset order you place to close your trade automatically once it reaches a certain price level. It's your emergency exit. Trading without a stop-loss is like driving a car with no brakes. You might be fine for a while, but when you need to stop, you're headed for a disaster. So, where do you place it? A good stop-loss isn't just a random number. It should be placed at a logical level, like just below a recent support level if you're buying, or just above a resistance level if you're selling. This way, your stop-loss is based on the market's structure, not just on how much money you're willing to lose. It's a strategic decision that says, if the price reaches this point, my trade idea was wrong, and it's time to get out. Another critical concept is the risk-to-reward ratio. Before you even enter a trade, you should know exactly how much you stand to win compared to how much you're risking. A healthy risk-to-reward ratio is at least 1:2. This means for every dollar you risk, you're aiming to make at least $2. Let's do the math. If your stop loss is set for a $100 loss, your take profit target should be at least $200. Why is this a game changer? It means you don't have to be right all the time to be profitable. You could be wrong on more than half your trades and still come out ahead. If you win just 4 out of 10 trades with a 1:2 ratio, you'll still be in profit. This takes immense pressure off your trading and shifts your focus to finding high-quality setups. Let's also touch on over-leveraging. Leverage is a double-edged sword. It can amplify your profits, but it can also magnify your losses at a terrifying speed. It's tempting, especially for beginners, to use high leverage to trade large positions with a small account. But this is one of the fastest ways to lose all your money. A sudden spike in the market can trigger a margin call and wipe you out before you even have a chance to react. My advice: be conservative with leverage. Use it as a tool, not a crutch. Your position size should always be determined by your 1% rule and your stop-loss placement, not by the maximum leverage your broker offers. Finally, let's talk about the emotional side of risk. Revenge trading and fear of missing out, or FOMO, are two of the biggest account killers. After a loss, it's natural to feel an urge to jump right back in and win your money back. Don't do it. This is revenge trading, and it's almost always a losing strategy because it's driven by emotion, not analysis. Take a break, step away from the charts, and come back with a clear head. Similarly, when you see the market moving fast without you, FOMO can trick you into chasing the price and entering a trade late, usually at the worst possible moment. Stick to your trading plan. If you missed a setup, another one will always come along. Patience is a virtue in trading, and it's a core part of managing your risk. So there you have it, the 1% rule. Strategic stop losses, a positive risk-to-reward ratio, avoiding over-leveraging, and mastering your emotions. These aren't just tips. They are the pillars of a sustainable trading career. Focus on protecting your capital first, and the profits will follow. Thanks so much for watching. If you found this video helpful, please give it a thumbs up and hit that subscribe button for more content if you want to become a smarter and a more profitable trader. See you in the next one.